Despite inflation rising in February, the report was in line with expectations. Is the Fed winning the inflation fight or not? Could the bank collapses change their plans for upcoming hikes? Let's bring in Greg Daco, chief economist at EY-Parthenon. We were joking it's Daco Tuesdays. Greg, welcome.
Great to be here.
So what is the significance of this morning's print in a nutshell, do you think?
Well, I think if we abstract a little bit from the current environment of banking stress, which I know is very difficult, we would be in an environment that would have otherwise pushed the Fed to increase interest rates by 50 basis points at next week's FOMC meeting. I think the discussion right now is likely to be more either a pause or 25 basis point rate hike, which I think is more likely. But I think you'll see Powell and the rest of policymakers highlighting a dual track approach. On the one end, monetary policy is still continuing to aim at reducing inflation. And on the other hand, macroprudential policy is essentially aimed at ensuring confidence and resilience in the banking sector.
Do you not take the collapse of several banks over the past, or at least two, over the past week, Greg, as signs that the tightening is playing out and the business cycle is rolling over and the lag is starting to catch up with us? And why should they keep hiking?
Well, I do absolutely think that we are in an environment where there is a gradual realization that the Fed can't do everything everywhere all at once. That essentially by raising rates, tightening monetary policy, it is leading to an environment of tighter financial conditions and now, very importantly, tighter credit conditions. Those will have an effect on interest rate sensitive sectors, but indirectly will also have effects on the broader economy, on business investment, on consumer spending, and that is going to continue to slow. I think the backdrop against which this is taking place is very important to keep in mind from a Fed perspective. So while they will continue to want to fight against inflation, and the latest CPI print will give them reason to do so, they have to be very cautious that in trying to battle inflation, they are increasing some of the risks, some of the vulnerabilities in terms of financial sector stress.
Greg, let me ask you what I fear is a dumb question, but I'm going to ask it nonetheless, and that is this. Is it conceivable that the actions of the FDIC and the Federal Reserve in putting money into the banking system or bank stopping it is in and of itself an inflationary force in the economy? Or is that something we need not worry about?
Well, I think we have to consider the fact that there is certainly interplay between macroprudential policy and monetary policy. By making the new program a program where the assets on banks' balance sheets are valued at par, this to some extent offsets the drag from tighter credit conditions, tighter interest rates or higher interest rates and tighter financial conditions. So there is interplay between the two. And I think to some extent that is why the Fed will want to continue pressing on the policy brakes in terms of raising the federal funds rate. A lot of observers were very quick to write off the possibility of the Fed tightening monetary policy any further, but we're seeing now that there is a return and more nuance to this narrative. I think we should not forget that Fed Chair Powell and the rest of policymakers at the Fed are very much concerned about their legacy. They do not want to be seen as having allowed inflation to run out of control. I'm more on the dovish side. I think we will start to see accelerating disinflation going forward, but the Fed seems to be more hawkish and convinced that it needs to do more in terms of monetary policy.
Do you see that disinflation? Do you see that disinflation in today's report?
I think we are starting to see signs of it. If you look at the composition of growth on a month-to-month basis, on a sequential basis, you're seeing that it's a large driver is still the shelter cost element. Services excluding shelter and excluding energy rose about 0.3% on a month-to-month basis. To me, that points to gradual disinflation. It's not going to be a straightforward and smooth process. It will be bumpy, but I think we are likely to see accelerating disinflation over the course of the next few months into the spring and summer, and that will bring inflation down closer to 2.5% by the start of next year.